Okay, good afternoon, everyone. It is such a pleasure to be with you today. I'm David with Axe Retirement Life Communities, and I wanted to thank you for joining us today as we explore our topic of planning for your retirement in an uncertain environment. We're pleased to have Brad Breeding, a certified financial planner, as our presenter today. Through his online company and his presentations, like the one today, Brad has provided valuable guidance to thousands of retirees like yourself who are navigating a complex senior living and lifestyle decisions. I think you'll enjoy hearing what Brad has for you today. And also, just to share with you, on top of Brad's extensive financial background, one fun fact is he played basketball at Laney High School in Wilmington, North Carolina. This is also where Michael Jordan played. In Brad's senior year, Michael actually showed up and for one of their practices ran some full court presses with them. Nothing like having the very best show you how it's done. So ladies and gentlemen, please welcome Brad Breeding.
Well, thank you, David. Good afternoon. So great to have all of you on the call. Dave asked for a fun fact, and obviously I shared the most memorable one that I have. Anytime we do, when you're involved with like an icebreaker type of thing, that's always my go-to moment I'll never forget, and very timely with the documentary that's out now on Michael Jordan and the Chicago Bulls and everything. So anyway, as David said, we're going to be talking today about the title you see before you, Planning Your Future in an Uncertain Environment. Really excited to be with all of you. Thank you so much for taking time to join the call today. Before we jump into the content of the presentation, just a little bit more about my background. As David said, I spent a number of years in the financial planning business, about 13, 14 years in that industry, prior to starting the company that I have now, which is called MyLifeSite, as you see here on the screen, mylifesite.net. It's really an online resource for tools and information to help guide people through what I call complex senior living decisions. And so what I do now is really kind of draw on my past experience combined with what the business that I'm in currently, and I really look at kind of the intersection of those two things, where financial planning sort of intersects with retirement living and so forth. The one thing I think is very important for you to know today is that I'm no longer actively practicing in the financial advising business. And so everything that I share with you today is purely objective. It's just really sort of my views and things like that. So along those lines, quick disclaimer, nothing that I share with you today should be construed as financial guidance or personal financial or investment advice. Certainly I would recommend that you all talk with your own professional, financial professionals, tax professionals before making any decisions about your own situation. And also, for those of you that may be new to webinars like this, or at least this particular type, GoToWebinar, just a few things that might be helpful for you. Number one, all of you are on mute right now, and that's by design, because with a call like this where we have possibly a couple of hundred people, we want to make sure that we don't have a lot of background noise and things like that. So you're on mute. That means this green or this microphone button should be like a gray. It should be the color of these two. If it's green, that means you've unmuted yourself. So if that happens, just click it again. But we want to make sure everybody's on mute. However, if you have questions as I go, feel free to submit those. There's a question section here in this toolbox. You click on that. You can type your question in and hit submit. And that will come to David, and he'll be able to see those as I'm presenting. And hopefully at the end of the call, we can take a couple of questions. And then finally, if you're having trouble getting this sort of toolbox, as I call it, off of your screen, there's an orange button. You click that, and that'll move it over so that you can see the slides. So what we're going to cover today, number one, I want to talk with you about what I believe to be the keys to financial security in any environment, whether the economy and the stock market's up or down or sideways. There's several things that I think are important, but particularly important right now, that we need to keep in mind. Secondly, I want to talk with you about taking a broader view of retirement planning. So often I think when we talk about retirement planning, there's a pretty narrow focus there. And so I think there's some other areas that people need to really be thinking about, particularly those who are in retirement. And then we'll talk about retirement living, senior living options, and how those kind of fit into the bigger picture about planning. And then finally, we'll talk a little bit about what's going on right now, obviously with coronavirus and senior living and some of the effects that we're seeing there and responses and so forth. So one of my favorite quotes comes from Mike Tyson, and he once said that everyone has a plan until they get punched. I think this can apply to a lot of situations in our lives, but really with what we're facing now, this quote came to mind because it kind of feels like we've gotten punched. This whole situation with coronavirus came on pretty rapidly and almost out of nowhere. And, it might feel like it's knocking us off our plan in so many ways. And so we have to start to ask, do we have the right plans in place? How do we stay on task with our plans? Things like that. So I really believe there's 3 keys to financial confidence, as I said, really in any environment, but particularly right now. And those 3 keys are perspective, objective, and a plan. So really, I believe each of these, if any one of these is missing, it becomes very difficult to maintain financial confidence. So for example, without perspective, it becomes easy for our emotions to start driving decisions. And sometimes those decisions can be more costly in the end. We need very clear objectives, because without clear objectives, it becomes very difficult to have a plan, or more importantly, it becomes difficult to even understand the effects on our plan of situations like we're seeing right now with the stock market and everything else. So what I want to do now is spend a little bit of time talking about each of these 3 things. So let's talk about perspective. So what I want to begin with is really a look kind of at the financial markets and where we are right now. There's obviously a lot of maybe fear would be a good word, certainly volatility and things like that. So I think during a time like this, as I said, perspective is very important. So one of the questions I've been asking people, and I would probably ask my clients this if I was still in financial planning, is how did you feel about your financial situation in 2016? Now, there's nothing magical about the year 2016, but what I'm really saying is if we were to just go back a few years, let's say you could take a time machine back, and you didn't know what was going to happen in 2017 or 18 or 19, but you were asked at that time how you felt about things, I suspect that most of you would have said you felt pretty good. Maybe not all of you. Everybody's situation is different, but by and large, most people would have said, we feel pretty good because we were well beyond, the financial crisis of 2007. The economy was gradually getting better. The stock market was gradually getting better. Not perfect. There's never any time that's perfect, but we were certainly seeing improvements. So just kind of hold on to this question for a moment. I'm going to come back to this in a couple of slides. So what we're looking at here is a broad look at the stock market in the United States. The Wilshire 5000 is just a broad-based index of the stock market in the U.S. Certainly there's international markets and things like that as well. But if we just look at this, you can see what's happened over the last 6 months. Okay, we obviously had this very steep drop as coronavirus started to appear. And since that time, we've had, almost surprisingly, I think many people would say, we've had a pretty good rebound back to the upside of about 20% or so. And so a lot of volatility, obviously. I think this, we'll talk about why this may have happened over these last few weeks. I think part of it certainly is a stimulus. We could debate, how effective that will ultimately be for different aspects of the economy, but nonetheless, I think it absolutely played a role in some of this rebound that we're seeing, combined with some other things. But when you look at this chart, when you look at the last 6 months, you'll notice that we're down about 6%, maybe closer to 7%. This doesn't include yesterday, so 6 to 7%. Now, the interesting thing about this is that most of the things that you see or read about, I've observed, tend to talk a lot about the drop from the high point. Now, remember, This point right here on this chart represents really an all-time high in the stock market, a 10-year bull run, longest bull run in the history of the stock market. And so the conversations and the headlines tend to be about, 30% drop from the high, or even now where we are today, we often talk about how far we are off of the highs. And the thing that I think is important to realize is if you just go out a little further, 6 months, we're down 6-7%. Now, I'm not suggesting that any of us like to see our account values come down. We would all love for our account values to go up indefinitely, but clearly we know things like this happen. But instead of just focusing on these big drops from the high, I think we have to take a little wider view. So to say the market's down about 6 or 7% probably doesn't sound quite as bad as it may feel based on everything that we see and read. And if we went out to a year, you'd probably find that we're about even over the past year. So, not the worst situation compared to some of the things that we may read about and that kind of thing. Now, I asked you about how would you feel in 2016? Well, let's just suppose you would have said, if you didn't know what was going to happen after that, if you said, hey, we feel great, things are moving in a good direction, our accounts have rebounded. Well, the interesting thing is since that time, if you look at 2016 down here, even with the most recent volatility, we're way ahead. In fact, we're about 45% above where we were in 2016 on a cumulative basis. Now, again, am I saying that we want our account values to go back to where it was in 2016? No, of course not. But this, at least in my mind, gives me a little bit of what I call a mental cushion to know that, things are somewhat relative. Now, the other thing that I would say that I think is important is that the stock market, even right now, in fact, even if I were to go back, when we were way down here a few weeks ago, the market even then was overpriced in most people's opinion. This is a look at what's called the Shiller PE ratio. Some of you may know what this means, others of you maybe not, but it's really just a way to look at the stock market and to measure what's the price, the average stock price relative to average earnings, in this case, of the S&P 500. That's 500 large company stocks in the U.S. And so most people agree that this is a pretty good measure for determining is the market overpriced or underpriced relative to the earnings of a company. And if you look at this, you'll notice that the median historically on an inflation-adjusted basis is around, just under 16. And yet right now, we're at about 26 or 27. So again, we've been at an all-time high with the stock market. Not saying we want to lose we don't want to see our account values going down, but the reality is that something was going to reset the market eventually. It needed to be reset. We know it's not just going to climb forever. And even now with this volatility, it's still, according to things like this, overpriced. And there's a number of other indicators suggesting the same thing. If you look at another thing, dividend yield. The lower the dividend yield, that suggests higher stock prices overall. And you can see that we are very close to a historical low in terms of dividend yields right now. So those two things together, again, point to the fact that the market is overpriced even now. So this kind of leads to the next thing, which is, this is an article that was in MarketWatch. And again, this was several weeks ago, back on, you can see March 16th. So this was before we had this more recent rebound that we've seen over the last few weeks. But even then, I saw several articles like this one that talked about, when valuations become attractive enough, courageous, contrarian-minded investors will step up to the plate and start buying. So what this is really saying is that there's a lot of people out there who look at this market right now, even a few weeks ago, and say, I don't know if it's smart to be putting money into the market right now. I know for myself personally, even before all this happened, I was a little uncomfortable putting my retirement dollars into a market that was at an all-time high, after a 10-year bull run, because that almost feels like the epitome of buying high and just waiting for it to come down. And so there are a lot of people who are kind of waiting for that dip. And I think that's some of why we've seen a rebound over these last few weeks. Again, the stimulus, I think, helped some as well. But there are a lot of people who are still, I think, waiting for the market to come down. And that's probably, I think that's a good thing in many ways because maybe that helps provide a little bit of a bottom. Now, most of you on this call, I'm assuming if you have retirement accounts and investment accounts that you're not 100% in stocks. You probably have, hopefully, some cash, but also some bond exposure. Now, there's lots of different types of bonds, short-term, long-term, intermediate, treasury, municipal, corporate, on and on. But just speaking kind of broadly, again, in general, if your accounts were allocated 50-50 between stocks and bonds, then you're probably over the last 6 months, probably around even. Now, this is just an approximation. Your account values obviously won't match this exactly, but just making the point that with a little bit of allocation and, then your returns are probably better even than what we've seen. You remember the stock market's down about 6 or 7% over this period of time. If you were, say, 40-60, then, you're probably up a little bit more, maybe 1% or so. So allocations make a big difference. Really, remember, what we're talking about here is just perspective. It's really just designed to help us kind of take a deep breath, realize maybe things aren't as bad in reality as they sort of seem with everything that you're hearing and reading about. And that's important to be able to do that during a time like this. Now, one of the questions that people always ask anytime we have volatility in the markets is the question you see here: have we seen the bottom? Where is the bottom? Well, the first thing I would say about that is that no one knows. I don't know, and I'm not going to try to pretend that I know. My neighbors don't know. Your neighbors don't know. The people on CNBC don't know. This is why you can watch 2 interviews, let's say back to back, of 2 institutional big investors, and they might have completely different views of what they think the market's going to do from here. So that just tells you that really nobody knows. I think the important thing to know, though, is that the market is a leading economic indicator. And usually, in most cases, if you look back historically with most recessions, what you'll find is that the stock market tends to rebound well before the actual economy, maybe 4 or 5, 6 months ahead. And the reason why is that, the market's always looking ahead. It's not looking at what's happening right now. And so, in some ways it is, because what's happening now could make an impact 6 months from now. But really, the stock market is kind of a collective opinion on whether we're going to be in a better or worse situation 6 months from now. And so when you think about that, I think that's probably the third reason we've seen a bump more to the upside over these last few weeks is, for whatever reason, collectively, investors feel like there's positive signs 6 months out. Maybe it's some combination of, treatments for coronavirus and a possible vaccine. I know that won't happen in 6 months, but, a combination of things. Again, treatments, maybe the gradual reopening of the economy and some possible optimism there. Whatever it is, something's driving that optimism. Now, in the next couple of weeks or so, if we start to see some more negative reports and some things start to appear not as good as maybe we had hoped, then I think we could absolutely see another decline in the stock market. But again, I think with this perspective, what we're really trying to do, as I said earlier, is have a little bit of kind of a mental cushion to say, if that happens, then maybe we have a little more wiggle room there than we thought. So let's talk for a moment about housing market for a moment, because some of you on this call, I'm assuming, are trying to decide whether this is a good time to sell your home or not. You're probably in conversation with the staff of the respective communities at ACTS that are hosting this call. Now, I'm not a real estate agent, so I'm not going to get too granular on this, but from a planning perspective, maybe there's some things that could be helpful that I'll share. So first thing, if you look at the national average of home prices, or the historical average, you'll see, as indicated by this chart, that we are at an all-time high. Now, this only goes through 2019. So very much like what I said about the stock market, housing prices also have been at an all-time high. This top line is the inflation-adjusted home prices. So a lot of things can drive up the prices of homes. We're building bigger homes. That's one thing. But nonetheless, you can see that we're at an all-time high here. another thing I'll say is I know home prices can vary dramatically in different markets. This is just an average of the whole entire nation. But if you look at this, you'll see that, kind of like I said before with the stock market, there was probably some reset that was due to happen eventually. Obviously, that's been prompted by the coronavirus. And there again, we don't want to see our home prices decrease, but the reality is those things are going to happen. But let's talk a little bit about, this idea of whether to sell or whether to wait. If you're thinking you might wait, there's just a few things I'd mention. Number one, the market conditions, the real estate market conditions are going to vary widely by region and segment, maybe even by your specific neighborhood and then segment. And what I mean by segment is pricing, where you fall within, whether you're priced at the upper tier of the market or kind of in the middle. So it's really those two things combined that are going to determine kind of the supply and inventory and how quickly you can sell your home. So you would want to talk with somebody experienced locally about that. But another thing is that all the projections that I'm seeing, and these are coming from the real estate industry and others, are showing projections of, home value price drops somewhere between 2 to 4% over the next 6 months to a year. And to put that in, sort of comparatively speaking, in 2007, we saw home prices decline by 27%. So that's a pretty big difference. I mean, even if these projections are off and we end up at 5 or 6 or even 10%, that's still substantially better than what we saw in 2007. And part of that's because I just think the fundamentals are much better than they were then. But the interesting thing is that inventories have stayed really tight in a lot of markets. Now, this may not be true in every market, but overall, what seems to be happening, as a realtor explained it to me, is that while there are fewer buyers, there's also fewer sellers. There have been people that are delisting their homes for various reasons. They just don't want to go through it with everything that's going on right now. So the equilibrium between those two hasn't changed as much. And so the way he put it to me was that, instead of getting 10 offers on your home, maybe you just get 3. And that sort of resonated. That I can understand what he's saying there. And the other thing that he mentioned to me, and then I read about actually this morning, in fact, was that between those who have delisted their homes right now and those who perhaps in a few months may have to sell their home just because of their situation economically, if all of those kind of come on the market at the same time, that could drive up inventories quite a bit. So we could find that it's much more difficult to sell a home, 6 months from now or a year from now, what have you, than it is now. And so I think that's an important consideration. I also think the record low mortgage rates that we're seeing are going to continue to help. How long those will last, we don't know. I think for the short term, certainly we'll continue to see low rates, but whether those could go up in 6 months or 8 months, who knows? A year? It's really hard to say, certainly in this type of environment. But, people want to get into those record low rates. So that's going to help. Every 1% that mortgage rates increase, that decreases purchasing power by about 10 or 11%. And so people don't want to be in that situation if they can help it. So that's certainly making a difference. But if you say you're going to wait till this kind of blows over or whatever, I would just make sure you know what it is that you're waiting for. I think that's the most important thing, to have that clearly defined. Otherwise you could just be waiting indefinitely, or perhaps waiting till you get to a situation that's even less favorable than it is now. So I don't know, if you're ready to sell but not ready to wait, you can maybe work out a rent back situation with somebody or things like that, ways to get creative. But these are, I think, important things to consider. So we've talked a little bit about perspective in the stock market and even the housing market, but now let's talk about objective. This is really important because without clear objectives, without clearly defined objectives, it's really almost impossible to measure the effect of stock market changes on your plan. So in other words, if you don't have very clear objectives, the market could be down 10, 20, 30%, whatever it is, and we really don't know what that means to you because we don't have very clear objectives of what we're trying to do. So let me give you an example, a couple of examples actually. Your primary objective may be to never run out of money to live comfortably. That's easy enough. I mean, as long as I know what you need to live comfortably and know what sort of wiggle room we have around that, this is pretty easy for an advisor to project out. But you might also say to never run out of money to live comfortably and to leave X amount to my family or charity. I think this is an important piece, actually, because now what this has done, you know, for a financial advisor, what they can do is they can say, okay, I know what you have now. I know how much you need in order to live comfortably, and I know what you want to have at the end. I can connect those dots, and I can plan pretty easily for that, just using some, you know, conservative growth rates and inflation rates and things of that nature. But if we don't have those things, it's really an arbitrary plan. And what starts to happen is our goal, our objective simply becomes to earn what we can with our money and to not lose it, and, you know, to lose as little as possible. But that's not really a plan. That's more of just investing. So you have to be able to tie that to something. Now, you may have secondary objectives as well. These may be things like to not be a burden on my family one day. You may also say, I want to protect against the cost of long-term care. And there could be others. These are secondary objectives that kind of flow up into your primary objectives, but still have to be planned for. And that leads to the last piece, which is plan. Perspective, objectives, and plan. So how do we now plan? Well, this kind of ties some of what I just told you together. I'm a big fan of keeping it simple. And what I mean by that is I think logically, this is how I like to think about it. The first thing I would do is look at all of your fixed or stable income sources. What I mean by that, I'm really talking about your non-investment related income. So if you take all of your retirement and investment accounts and put those aside for a moment, what are all of your other income sources? Social Security would certainly be one. For many of you, that may be your only other income source. Some of you may be a pension, assuming that it's a reliable, well-funded pension. You know, there's obviously different situations that we're seeing there, but rental income perhaps could be in there, again, if it's kind of a reliable long-term income stream. But all of those other income sources, add those up. And then you want to look at what are your living expenses, total, discretionary and non-discretionary. Obviously, discretionary is where we have a little more wiggle room to make adjustments if we need to. Right now, all of us probably are seeing our discretionary expenses come down quite a bit because we're not doing as many things. We're not eating out and these kind of things that we might normally do. So if you look at these two things combined, what you're going to find is that there's either a shortfall or a surplus. Now, some people will be fortunate enough to have a surplus, meaning that all of their non-investment income covers their living expenses. In that case, whatever they have in investments, they're not having to rely on that. So whatever's happening in the stock market is not going to be as big of a deal, at least not in terms of meeting their objectives, as it may be for others. Now, most people are going to have a shortfall. That's not uncommon at all. When I say most people, I mean most people in retirement. Because the whole reason we have retirement accounts and IRAs and things like this is to kind of cover or make up for what our fixed income sources don't cover, to fill that gap. And so when you think about that, once we know what that shortfall is, you know, once we know that amount, then we can look at all of your other savings, your retirement accounts and your investments, and we can say, okay, how much do we need to withdraw from those every year and still, you know, and meet your income goals? And then we will look at your objectives. If your objective is to leave X amount at the end, maybe that's 100,000, maybe it's $1 million, maybe it's 5 million, whatever it is based on your situation. But I can look at this and say, okay, even though we've seen the stock market drop, does that have a significant impact on our ability to be able to meet your long-term objectives? Yes or no? And again, that's pretty easy to project out. But if we don't know what those objectives are, you know, then again, it's kind of an arbitrary plan. So it's really just, is there enough in your savings and retirements, even with a potential decline, to meet those living expenses today and to meet your longer term objectives. One of the things I've also been telling people, people get really fearful in the stock market, and sometimes, I had a client I remember who had plenty of money, more than enough money to meet their living expenses, but he was always terrified when the market was not doing well. And I kept having to say, listen, it's not really impacting your situation. Yes, your accounts are down, but you're still you still have plenty to meet your objectives. But what I tell people sometimes is don't take any more risk with your money than you need to, while still giving yourself a high probability of achieving your goals. So if somebody only needs to earn 3% a year on average on their money in order to have a high chance of meeting all their objectives, then why try to earn 7, 8, or 9%? So that's just taking undue risk and undue stress. That's something I encourage people to think about. All right, so now let's talk about planning beyond finances. If I use the phrase retirement planning, most people think about investments, or they think about financial planning. But there's more to it than just that, in my opinion. This is a survey that was done by Merrill Lynch several years ago, and they haven't updated it. I wish they would, but I'm not sure it would show anything entirely different from what we see here. But they asked people in retirement, what are your biggest concerns about living a long life? And you can see the answers here. Serious health problems. The second most popular answer is not being a burden on my family. Even things like being lonely and not having a purpose. So when you look at this, you'll realize a few of these don't even have anything to do with money, at least not directly speaking. But furthermore, these are all, if you think about what does peace of mind mean for you, if you were to really stop and think about what peace of mind represents for you in your life, I would bet that for many of you, it really means the potential to guard against or to minimize these kind of concerns. And the extent to which you can do that, that's going to drive up peace of mind. So with that being said, when I think about what is a retirement plan, which, by the way, continues throughout retirement, there are 4 categories, in my opinion. The first is finances. We've talked a little bit about that. And the other 3 categories still kind of eventually come back to finances in some way. But the next area I would call, that I would suggest is called preventative health, or you might say lifestyle. This is really how you live today. And what I'm really talking about is all the various components of wellness: intellectual, social, emotional, physical, vocational, so forth and so on. All of these things are important because not only are they going to help you to live a healthier and better lifestyle today, but they also, too, in theory, will lower potential medical costs later. Now, that's not to say there won't be outlying situations that can appear, but in theory, the healthier lifestyle you're living, the fewer medical bills you'll have over time. The next thing is what I call post-health event. What's your post-health event plan? Even if you do live a healthy lifestyle, we know that things can change, sometimes suddenly and unexpectedly, whether it's a stroke or a heart attack or a fall or something else. And these are the kind of things that just turn our world upside down, can become a very emergency or crisis type of situation where the whole family kind of has to scramble. And so my question to people is, what is your post-health event plan? Where would you receive the care that you need? Who would provide it? Would it be good quality care? And so forth. And also, what would be the involvement of your family? Would you want their involvement? Are they nearby? Do you have family members, adult children nearby, and those kind of things? The reason I look at these 4 categories is because if you think of that survey I showed you a moment ago, each of the answers falls into one of these categories. And as I said, they all come back and touch on finances in some way. As an example, family caregivers. Well, there's a really big financial cost for that people often don't realize, whether it's retiring early, taking time away from careers, out-of-pocket costs, and even the inability to contribute to retirement accounts because of their time away. So all of these things do, as I said, come back to finances in some way. But here's the most important point, I think, for our call, is that where you live throughout your retirement years plays a really big role in each of these things. Housing is a very important part of your overall retirement plan. Again, we can look at each of these categories. You look at this one. Two of those answers are being lonely, not having a purpose. Well, where somebody lives, that really plays an important role in that. The kind of the social network around them, where they are, their neighbors, if they have people around, and so forth. You think about your post-health event. That absolutely has a role. Where you live plays a role in your plan for that. Whether you're a burden on your family or not, where you live plays a role in that. So housing is an important part of all of this. So with that in mind, let's talk about the retirement living options. So obviously, staying in your own home is one option, but what are the different senior living type options? A lot of people, it seems to be there's so much confusion out there among the different types of senior living providers. And there's just a few of the terms on here: active adult neighborhoods, rental retirement, independent living, continuing care, life plan, so forth and so on. Sometimes these terms are used interchangeably. Sometimes they're used incorrectly. So I always tell people, it's important, I think, to kind of put terminology aside and recognize that anytime you're looking at a retirement community, or particularly if you're doing comparisons, there's four key trade-offs that you need to consider in order to do a true apples-to-apples comparison. The first is what the cost today. And what I mean by today is while you're not receiving any sort of care, you're living independently, and maybe you're still very active, you live in that retirement community, what's your cost today? You have the monthly cost, possibly an entry fee, but what's the cost today? That's the first area. The second is what I call hospitality services and amenities. You could even put things in here like the location and perhaps even the view, size of the floor plan, whatever. But the reality is some communities simply provide more than others in the way of services and amenities and things like that. So that's going to have a bearing on cost, and that's important to take into consideration. But then you have to think about the future as well. So what types of care are available? Some retirement communities provide very little in the way of care. Others provide a little bit, and others provide the whole spectrum. So the ACTS organization hosting this call today, I know their communities provide the full spectrum. At least most of them do, I think. They provide the full spectrum, everything from independent to nursing care, assisted living, in between, and so forth. So what types of care are available? So now we're thinking not just about what you need today in terms of services and amenities, but also what's available for the future if something were to change. And then finally, what's the cost of that care? Whatever care is available, what's the cost? This is important too, because there's usually trade-offs here. In other words, some communities, many of the ACTS communities, if not all of them, I think, offer life care type contracts, meaning that you basically continue to pay the same monthly rate, no matter whether you're living independently or receiving care. Other types of communities, you'll pay the full market cost of care when you need it. And there's usually, again, all of these things, there's trade-offs. Sometimes you may find you pay a little bit more today, but less later if you need care. Those are the kind of trade-offs we're talking about. So understanding that helps you to make better comparisons. So now I'm going to spend just the last few minutes talking about, kind of the coronavirus, just because I know that's on everybody's mind. Now, I'm not a healthcare administrator or a nursing care administrator, so I'm not going to get into a lot of detail on this either. But I'm just going to give you sort of my observations, just my outside perspective of some of the things that I'm seeing and hearing in conversations and in the things that I'm reading. And so the first thing I think is important to recognize when we talk about the coronavirus is we have to kind of separate, I think, in our minds, independent living from what I call care settings, nursing homes. So obviously we know from the news that the biggest impact is being felt in nursing care settings. Most of the time, not all of the time, but many of these cases have been kind of freestanding nursing homes and that kind of thing. But obviously we know that's where most of this has taken place. Now, what I would say, a couple of things. Number one, the vast majority of nursing care providers out there have not experienced outbreaks. And we don't hear that enough. I don't think. You tend to always hear about the most negative things, but the vast majority have not. But even some of those that have, really, I would say in many ways, it was just a difficult situation. Some facilities not been provided with what they need. They're doing their very best to make sure that this thing's locked down, that it's not spreading. They're following protocols, but they haven't had the equipment or the tests that they need sometimes, and things like that. And then, anytime you have a brand new virus with symptom-free spreading, that's obviously a very difficult thing. So those earliest cases, whether it was in a nursing facility or just in a broad community, a community in general, where things kind of got out of control, it's just those earliest ones, that symptom-free spread made that very difficult. I think now, obviously, we know what's going on, and to the extent that nursing facilities can get what they need, they're putting the protocols in place, have been for some time now, and it's making a difference. I know it's making a difference, but the healthcare workers in these nursing care facilities, they're putting themselves on the line every day, and you just don't hear about that enough. You hear about that for the hospital workers and things like that, but nursing care workers are doing the same thing, and they're working really hard and putting their lives on the line too. I've even heard of some cases have been imported from hospitals here in North Carolina. I just saw this week where, we've started reporting cases, the state's reporting cases, and they reported an outbreak at a community or at a nursing facility here in North Carolina where the cases had come to them from a hospital. And so the hospital sent these cases to them, and they did their best to care for these people, but then it was reported as an outbreak. So you can imagine how that must have felt to that organization. So you have a lot of things like that. But I think the bigger point is that the industry, I believe, is really going to learn a lot from this. I think we all are. I hope. It would be a shame to have this situation and not learn from it. But for those who may not need care, for years from now, that many of you on this call, if you ever need it, I think the things that are being learned now, some of the changes that will take place in response to this, is only going to make the industry better long term. And certainly there will be some changes. It's too soon to say exactly what those will be, but I know there's already a lot of discussion around this at a regulatory standpoint and within the industry, and I think all of that's only going to make things better going forward. But I want to talk a little bit about independent living, because this is a different situation. Those in independent living obviously have a little more flexibility, maybe not as much as they would like, but certainly more flexibility. They can walk around the campus, and I'll show you some examples in a moment. They can take walks, or, if there's walking trails. Where I was talking to an organization just this morning, they said all their residents are riding bikes. They've never seen so many people riding bikes and this kind of thing. So anyway, there is that type of flexibility. But, the thing that I talk about, I've had people who know the business that I'm in, and they'll say, what are people in retirement communities saying? They're kind of locked down. And I always say, well, we're all locked down. I mean, my family and I, we've been locked down too. We haven't been able to go out and socialize and do the things we would like to do. We have to go buy our groceries, and I kind of wish we didn't have to because of the exposure there. So, this is a situation where really it's kind of like we're all facing some of these things. But what I have noticed, what has really been pretty incredible to me, is that the staff and the services are so highly valued among residents. I have seen so many things, and I'll share a couple of them with you in a minute, but the residents by and large are so grateful to be where they are. And that's been really, really neat for me to see. And that sense of gratitude, that sense of community, I've noticed that even with the social isolation, there is still a lot to be said for being a part of a community, a part of a network of support that I think that really plays into the whole wellness conversation right now. Just a couple of examples. We collect a lot of articles at our company. This is one from the Dallas Morning News that I came across a few weeks ago. And this gentleman, this resident, he said that everyone he's talked to feels far from trapped. In fact, they're grateful. If there's a good place to be at a time like this, it's here, he said. And then he went on to say, the people here, we share the good times and the bad times, so we'll make it through this. That concept of we will make it through this, that to me spoke very loudly, because it says to me, he actually went on in the article and talks about how he can't imagine if he was living by himself right now through all of this. So that concept of we, that community spirit, is still very strong. This was a testimony. I've received lots of these people have shared testimonials with me and stuff, or the staff members have shown me the things their residents are saying. And this is just one of many that I've seen. But this was a couple expressing their appreciation to management and staff for all they've done to keep them informed and safe and fed and involved mentally and physically. Deliveries, talk about deliveries of meals that have arrived in a timely manner. I mean, I wish my family and I had meals delivered to us every day right now. That would be really nice. And so a special thanks to these individuals. So this is just, a couple of examples of the things that I'm seeing where residents, where many people I think believe, gosh, what are they doing? They're on lockdown. They can't do anything. But the residents, by and large, maybe not all of them, but feel very grateful to be where they are. And what they're doing, I've noticed, is this resiliency, this idea of maintaining community, even with what's happening right now. These are just a few examples, but socially distant block parties and a lot of happy hours I've read and heard about. Things like, contributing by giving or making masks that they're sharing with healthcare workers in the community, parades, exercise classes and cooking classes by video. I heard recently that one of the chef, the on-site chef for this community, was giving cooking lessons to the residents, and that was a big hit. So all kinds of things like that I think are really impressive. Now, the last thing I'm going to talk about here is, this question of will people still want to be in congregate living? Would they be better off in their homes and things like that? And we wrote a blog post this week about this on our website. But, there's a lot of things that I think people need to really consider. And the reality for me is that a lot of the challenges that come with aging in place are really magnified right now. So, you think about the fact, if you're at home, particularly if you need caregivers coming out of your house, and not knowing their exposure, maybe they have to work a second and third job. Now, you could hire them full time to stay at your house, but that's going to be exorbitantly expensive. Just the process of managing that whole situation, all of that's magnified. And then things just as simple as, again, as I said, getting your meals on a regular basis, social isolation. For so many people, that social isolation factor is increased substantially right now because they're in their own homes and isolated, and video is nice, but it's no substitute for, personal interaction. And so a lot of these things, can your family be there or not? What has been their exposure? Can they get too close? All of these kind of things are really difficult. So I think it's important to weigh all this out. Now, I'm not saying there's a one-size-fits-all, that everybody should live in a retirement community. No, certainly not. I realize there's a lot of different variables at play in everybody's situation. But these are things that I think are important to consider, because at first glance, and if you watch the news and the media, they make it sound like they kind of paint everything under one stroke, and that's just not the reality. There's a lot of things to consider. So with that, I'll do a quick summary, and then we'll go to a Q&A. So number one, have clear objectives and plan accordingly. I talked about how important, without those objectives, you really can't have a plan. Keep perspective. When we lose perspective, our emotions start to drive the plan, and that can sometimes be costly. Keep it simple. Remember, I talked about your sort of stable income sources, your expenses, and then just, what's that difference, and can we make that up? Or has, whatever's happening in the market, has that really altered our ability to meet those objectives or not? Retirement planning is more than just financial planning. Remember, where you live throughout your retirement plays a big role in all those concerns that I talked about. The challenges of aging in place may be magnified right now with everything going on. And then finally, I think that senior living, just in general, is going to learn from this. And in terms of the care that's provided, I think that'll only be better and safer in the future because of what's being learned now. So with that, I want to thank you all for joining the call. Again, it was a pleasure to present. I hope you learned something that can be of help to you as you go forward from here. And so we do have a few minutes left, so I'll ask David, if you want to come back on the call and let us know if we have any questions we can answer.
We do, absolutely. Thank you, Brad. That was fantastic. One of the questions
Sure.
I'm seeing here, is there a tax advantage to living in a CCRC?
Yes, there very much can be a tax advantage in many cases. So we don't have a lot of time to go into a ton of detail, but CCRCs offer a number of different types of residency contracts. And again, I won't get into all that, but with some types, you can get a bigger deduction than others. So most of the ACTS communities, if not all of them, I know, offer, as I said, something called a life care contract, which basically just means you continue to pay the same monthly rate no matter whether you're living independently or receiving care and so forth. And with those types of contracts, normally you can get a pretty sizable tax deduction as a prepaid medical expense. That applies to the entry fee, if applicable, as well as the monthly fees. And so what will happen, the residents will usually get a letter, usually in January, from management that says, based on our expenses and our budget and our healthcare allocations, here's the formula. And you might find that's anywhere from 20, 30, 40%. Now, the one thing I would say is that you have to itemize. If you take the standard deduction, which a lot of people are now because it was raised, then you may not, or I shouldn't say may not, if you take the standard deduction, you won't be able to do that. However, the year you move in, it might make sense to itemize because of that deduction. So your tax advisor could weigh that out for you. Good question.
Very good. Another one here, Brad. Is there enough with the boomer generation available units around the United States?
You know, I'm getting that question a lot lately. It seems that there are many who are kind of thinking, oh my gosh, is all the inventory going to be, used up? Do we need to get in ahead of this and that kind of thing? And I think really that's not something that could be answered on a national level. I know that there are many regions or markets where there's not enough supply of senior living right now. I know there's other markets where there's an oversupply of senior living. So I think that's really something you'd have to look at by market. I will say, I would suspect that over the next year or two, as a result of what we're seeing now, that construction of new communities will probably be slower than anticipated. So when you weigh out the growth in our aging population and slowing development of new units, then perhaps there could be a squeeze in a couple of years. But there again, I think it's more going to be based on market than nationally. It's just hard to say nationally what will happen.
Okay. And I'll give you one last one. I kind of picked this one. I'm not sure who this is from, but what is the difference between for-profit and not-for-profit?
Well, I mean, when you get right down to it, a for-profit retirement community is, as that implies, it's operating for a profit. So there's shareholders that are receiving, returns, hopefully, receiving returns on that, whether it's form of dividends or other types of returns. So there's investors in a for-profit. With a not-for-profit, obviously, you don't have that. Now, that doesn't mean that not-for-profits aren't trying to make money, and the people that work there are earning salaries and executives and everything else, but it's not a profit-driven entity. And so, what a lot of people will say, another difference is that sometimes you'll hear that a for-profit will, quote-unquote, kick you out if you run out of money. That's not always exact. It's not black and white. There are some. I've read plenty of contracts from for-profits that say if you run out of money, you have X number of days. And, they're pretty forthcoming with that. Not-for-profits, you don't find that. And the reason why is because that's really part of being a not-for-profit is there's some charitable mission quite often. And so a lot of times what that nonprofit will say is that if our residents run out of money, we're going to keep them there. They're going to offset that shortfall, to be able to keep them there. And so that's a big part of the not-for-profit. But sometimes people say, is one better than the other? And I don't necessarily. I mean, not-for-profits, you may find it a little more mission-driven, a little different mindset maybe. For-profits, a little bit different. But I've seen both that are very well run. And when you get right down to it, the most important thing is living where you're happy. That's to me, that's the main thing, is picking the right community for you.
Fantastic. Well, Brad, thank you so much for your time. We greatly appreciate this. This was such a pleasure to do with you. Really enjoyed it.
Great. I'm glad you did. Thank you, David. Well, I wish all of you the best of luck. Thank you for your time, and stay safe.